I can learn to
Technology is not cooperating with me today. All right, here we go. Share screen. All right, so I hope you watched my video on chapter 7 and 9. So to some degree, chapter 7 and 9 are a review of what you should have studied, at least to some degree, in the first course. Typically in the first course, I stop at job order question. I know Professor Bhattacharjee, it depends on the semester how far he gets. He might actually cover more like process costing and stuff. But you all should be familiar with the concept of allocating costs, at least because it's talked about in the end of the first course. Even if you didn't have it, you should, if you worked in any sort of business, dealt with any sort of projects or budgets or anything like that, you should have at one point or the other dealt with the problem of allocating joint costs. What is a joint cost or overhead or indirect costs? They're all the same terms. There are costs that you can directly attribute to a product, like I know this phone, right? I mean, it's made of plastic and glass and whatever. A worker assembled it, so to the extent that the time that the worker had spent, the cost of that time is the direct labor, is the direct materials and direct labor. But this phone was produced at the factory, which did multiple other products, which has a lot of other things other than just the actual production of that phone, security guards, machine maintenance, IT department, what have you. Those are all indirect costs, or joint costs, in the sense that they are applicable to all products produced, not just one product necessarily. So, those are the costs that somehow it's important to allocate them, that is, attribute them to individual products. Right, because you want to somehow cost them, because that's the notion of absorption costing, right? On one hand, you could say, okay, I don't care about this joint costs. I'm just going to only consider the direct costs, direct variable costs in particular, of producing this iPhone, and forget about the fixed costs. I'm only going to care about variable costs. But the problem with the approach is that it ignores the economic reason for why these fixed costs or indirect costs exist, is because they're there to produce those products. Yes, they're not directly traceable to those products, but it's also not fair to basically say they're there for no reason, right? But they incur still cost of production. They're just not as easy to trace to individual products. So therefore, somehow you need to come up with some logical way of allocating those costs to those individual products. So that's what cost allocation is about. Now, the problem is that there is no right way of doing it. There is no right way of doing it. There is a way, and you need to come up with a meaningful way. You can, the whole point, by the way, of different ways that have been proposed over time of allocating costs is that how precise you want to be in cost allocation, right? How precise you want to be. Because, being precise costs money, right? It's one thing if you are, let's imagine for a minute you are in a factory that produces one product, right? Then you can pretty much trace everything to that individual product. Now imagine you're in a factory that produces 100 different products. Well, if you want to know exactly what was the amount of indirect costs consumed by every product, it would require a lot of information gathering. You need to somehow trace those costs to that production, decide how to allocate them. That all requires accountants' time. It all requires, you may have to hire consultants that will walk around. You're doing cost studies. And your book talks about it a little bit early on. Management consultants used to go around, like they would go on the factory floor and basically shadow the workers and say, okay, Pevsner, how much time are you spending on this? How much time are you spending on that? And kind of try to figure out how productive you were and like which products consume more of my time. And right? All of it's great, right? It gives you that level of precision, but on the other hand, it costs money. So because it costs money, you need to have a system for if you don't want to spend a lot of money, you need to have some sort of a educated guess, for lack of a better word. You need to have a rough estimate for like how to allocate costs, right? Some sort of a logical estimate. Now, obviously, then it becomes a matter of opinion, right? Well, what should that be? How you want to allocate this cost on the basis of some sort of a cost driver, right? So you have a cost object, that's the product to which the cost attach. There's the cost driver, right? What's the cost driver or allocation base? Presumably, it is something that correlates with that cost, right? So, for instance, if you have a machine that works on a number of different products, well, the cost of that machine, the consumption cost of that machine, it should be correlated with how many batches of those products it processes over time. So ideally you would like to pick a cost driver as an allocation base, which has some sort of a sufficiently high correlation with true economic driver of those costs. Now, but the problem is that some products, it's a guess, right? Some products might have more of a correlation, some products have less of a correlation. For some products, you might actually be capturing, if you pick the particular driver X, whether it's labor hours, or it's machine hours, whether it's number of batches, whether it's number of product runs, whether it's in academia, it's credit hours, whether that we allocate costs over, whether it's square footage, whether it's whatever you want, whatever number you want. For some products or some activities, or costs driving activities, it might be a really good approximator, but for some it might be really horrible. So, and the truth is, there is no one size fits it all driver that you can pick. Then you have a choice. Either you pick something and you go with it, and you kind of accept that for some types of course it will capture it pretty well, the economic reality, and for some it won't. Or you have to go and be very precise in your measurement and figure out what drives what costs and allocate costs on the basis of those individual drivers. And that's the point of something called activity-based costing. Activity-based costing is basically a very simple idea. It says, okay, for every type of cost I incur, I will go and investigate and be very precise about what the cost driver is, and I will only allocate that cost on the basis of that cost driver. Now, so what does that mean? So imagine, and I'm going to pick academia because this is something that I work with them pretty closely. So suppose, let's take me, right? And again, for Virginia Tech, I am a variable cost, purely variable, because either you pay me, you don't pay me. You offer a class, you don't offer a class. Or I should say I'm purely variable because it's fixed within the range of your course, right? If this course is just, if the Virginia Tech decides to offer this class on a range of this class size, I'm a fixed cost, my salary, my compensation. Now it's a stepwise variable cost, right? So as the number of students goes up and it goes over whatever the class size limit is in Virginia Tech, you may have to offer another section. But imagine now, so I'm kind of easy, right? My costs are traceable, and it's okay to just assume I'm a variable cost within a certain range, over a certain range. Now, what about the dean of the MBA program, right? So that's a fixed cost. It's a joint cost, his salary or her salary. And so think of it this way. Suppose the question becomes, in the MBA program, I'm sorry, in the business school, I'm aware of at least 2 different programs. There's the Masters of MBA, actually 3 I'm aware of. There's the MBA, there's the Executive MBA, and there's the Masters of Technology, right, of Business Information Technology. So suppose we need to decide whether those profit programs make money, right? And this is something that in academia is a very salient point in question right now, because we're under tremendous enrollment pressures because of the current situation and so on, right? Or maybe you want to ask a question: should we increase tuition? Should we reduce tuition? Right? Well, let's say we want to attract more students. Do we want to reduce tuition? Can we reduce tuition to, and stay profitable? Right? That's the question. Right? With the cost of instructors, if the instructor is assigned to one program, not a big deal, right? It's that you offer a class or you don't offer a class. Okay, fine. Now, but the dean is more complicated. On one hand, the dean costs, extra, let's say $300,000, right? Their salary, just gonna, or $250,000, whatever that might be. How do you allocate this cost between these 3 programs? So why do you want to allocate that cost? Well, because the dean is there, right? The dean needs to be paid. The dean manages all 3 programs. The dean manages all 3 programs. So what should be the cost drivers or allocation base for the dean's salary? So I'm asking you a question. And anybody, any ideas, any suggestions? How would you allocate dean's salary between these 3 programs?
Maybe by the proportion of students out of all 3 that are in each program, something like that.
So, okay, just by the sheer numbers. So let's say, okay, MBA program has the most students, and so they'll get the biggest allocation cut of the dean's salary. Is that what you're suggesting?
Yeah, that's the one.
Okay, that's fine. That's a reasonable suggestion. That's often is employed. But well, let me ask you a different question. So, what is required for this approach to produce reasonably correct as in a sense, meaningful and not distorted results? What assumptions should be true for that to happen? Anybody? Any thoughts?
That one student isn't enrolled in 2 programs, for example.
Okay, fine. That's fair. Because then it becomes even more complicated, right? How do you count their revenues? Because there's they probably can probably double count some courses from one to the other, right? So that then, okay. I thought of something actually less complicated than that. Anyone else? Any other thoughts? Should I make a proposal?
Sure.
Yeah.
It requires an assumption. It works well if the revenue, if the tuition between across 3 programs is approximately the same. Right? Because if it's not, what's going to happen? What's going to happen is that, it is not as visible necessarily with the, because it is probably true actually in this case. But I'll tell you, we ran into this issue. I personally ran into this issue in my program because we have an undergraduate program. We have a graduate program, right? We have an undergrad business and we have a grad MBA. And we have about, I don't know, today we probably have, I'd say 500 undergraduate students, about 600 graduate students. I want to take a guess. I don't even know what those numbers are anymore. The problem is with the undergraduate, the tuition is half of the graduate. If I were to take the dean's salary and allocate it, in my case, it would be almost 50-50, right? Half and half. It would make our undergraduate program look incredibly unprofitable. incredibly unprofitable. And graduate program, very profitable, right? Now, any thoughts about that? Like, if you were to do a cost allocation for my school, and this is the calculation that would yield, what would you say? So my school cross-subsidizes the undergraduate program. This is the conclusion you would draw, right? But the problem is that fair? Is that a fair characterization? Well, it's a fair characterization of what? If the dean spends approximately equal amount of time on the undergraduate program versus the graduate program. That's what I would say, right? If the dean is there and is a lot of half of his effort goes to the undergraduate program and versus the graduate program, then fine. That's fine. Then maybe we should think about, do we need an undergraduate program then? But I know this for the fact not to be the case, because most deans spend a lot more time on the graduate versus undergraduate, right? Because that's a more important program typically. MBA tends to be much more important to the graduate deans. I don't know if this is for the fact. I suspect that's not the case, and that's a, and that's a very serious problem. I don't know how to answer that, right? So I don't know how to address that. So what would be maybe a better way of doing it rather than just on the basis of student count? Can you allocate on the basis of relative revenues of the two programs? What do you think? Would that be a better approach? Guys, are you there? Hello?
Yeah, no, we're here. We can hear you.
So what are your thoughts?
Yeah.
I asked the question.
It seems like it might be less distortion.
What does Zimmerman call this allocation if I allocate it on the basis of revenues? He calls this non-insulating allocation, right? Non-insulating. When you allocate, if you have two different products or divisions, and you allocate on the basis of performance measures that are correlated to each other, right? So that's called non-insulating. When performance of one is correlated, the allocation of one is allocated. Well, it depends on the allocation of the other. Depends on the revenue base or profit base. That's non-insulating allocation. He talks about that being preferable because it kind of makes it less volatile, right? Like in the bad times, everybody does poorly, so it kind of smooths it out, right? A little bit. If one division does poor, the other one does better, so the better division will consume more of a cost. So then the worst division doesn't do as bad. Or there's a non-insulating, insulating allocation where in the example we talked about, the number of students allocation would be called insulating, right? It's not based on performance. It's not based on profitability, just based on the outcome. Or maybe you could say, I'll just allocate 25-75, whatever. And that's also not driven by performance. Now, the problem is, no matter what you do, they're not going to get the right answer. Right, the perfect answer. So what would give you a perfect answer? Well, you need to hire a consultant and walk around the dean every day, and trace his time and say, okay, dean, today you spent X number of hours on this program, Y number of hours on that program, right? And then say, okay, we've traced this time over a month, and so we've discovered that this is how many hours is spent on undergrad, this is how many hours is spent on the grad. And that's just, that's how we're going to allocate. Well, that's just too expensive to do that. You need to hire somebody, just to walk around, trace their time, and so on. So, that's the reason why people go with this sorts of approximations. But whether it's square footage, whether it's number of students, whether it's relative revenues, whatever. But my point, the point that I'm trying to make is that there's no perfect answer, and each answer will kind of produce some distortion, right, because of that. And the question that you want to ask yourself You need to be cognizant of those distortions. And all the examples we'll talk about today, we'll see how the answer changes depending on what base of allocation you're going to choose. And then just kind of want to make sure it doesn't drive you off the cliff, right? Doesn't drive you off the cliff. So I kind of answered the first two questions already. Why does Zimmerman talk about cost allocation as a tax? And the reason why, and I like that analogy, because think about what taxation is. Taxation is essentially allocation of the cost of the government to all of us, right? By charging me taxes, they say, okay, Pevsner, we're going to tax you. You're going to absorb the cost of defense. This is how you absorb the cost of defense, of the roads, whatever. Now, and there's different ways to tax people. Different ways to tax people. We in America have what's called a progressive system of taxation. The more money you make, the higher taxes you pay. In some countries, they have what's called a flat tax, right? Everybody just pays the same percentage. And there is advantages and disadvantages of it, right? Conservatives, for example, love flat tax system. Why? Anybody knows, or anybody has any suggestions? So everybody just pays 10% of their income. What's the argument for it?
But the argument for a flat tax?
Yeah.
Simple. It reduces the amount of man hours needed for the government to figure out how much you owe and stuff like that, right?
So it reduces the cost of IRS, that's what you're trying to say?
It reduces the cost of people I guess it gets rid of tax people like H&R Block and stuff, because you don't need somebody to do your taxes anymore. You just pay 10%.
Oh, yeah, I see. Okay, that's one argument, but is this the only reason why?
The only argument for it?
That you agree with, but do they advance any other arguments?
I don't know.
It also points away from stifling more income growth based off progressive taxes. So, obviously, right now it's kind of decentralized because the more money you make, the more taxes you pay. Whereas, on a flat tax, everyone would just pay the same, so it wouldn't really matter. You wouldn't have a kind of a set goal where you'd stop making money.
Okay, that's what I was kind of going after.
But isn't the biggest problem that, it's I guess that as an individual, the more you make, the more you pay. And if you don't make a lot, then proportionally you lose more than when you do make a lot.
Well, that's exactly the argument against the flat tax.
Mm-hmm.
That's exactly the argument for progressive taxation.
Right.
So my question is there a right answer?
Well, it depends. It depends if you're. We go back to those utilitarian principles, right? So $100. So let's say you pay 10% of. If you make $1,000 a month and you pay $100, that's more to you than a guy that makes $1 million and pays $100,000 because he still has $900,000 left. So where you only have 900. So it depends. I mean, I don't know.
That's exactly
this is political, right?
It depends on what you right. It depends on what you want to. Well, in the case of the government, it depends on what your objective of the tax policy is, right? Yeah. So government has utility. You're going to call them utilitarian, social policy, philosophical objectives, whatever you want. And then business, it's not. But in the end of the day, one system is not inherently right or inherently wrong. It just produces different outcomes and results in different economic response of the population. The same exact situation arises in how you allocate costs, right? So, if I'm in the provost and I want to say, okay, I want to incentivize the dean to spend more time on the MBA program, I would prefer an allocation system which would allocate less to the MBA program, right? Because, or I'm the dean, right? Because I would want them to, that's where I would want to see more profitability shown, right? Potentially. So if I care about the undergraduate program and I want the undergraduate program look better, then I would prefer the allocation scheme which would make our undergraduate program look better. That's that simple. But the bottom line, I agree with the Zimmerman's characterization of the cost allocation or overhead as a tax, in the sense that it's kind of arbitrary, right? Congress got together and said, that's how we're going to tax people, because we believe in progressive taxation, right? In some other countries, they believe in flat taxation. And that creates economic outcomes on the basis of the choice of allocation choice. Now, the reason why I'm spending a lot of time on that is not because I like to philosophize on accounting issues, because that actually, this is a very important topic for all of you. If you're ever going to manage any sort of project, or you're going to manage a team, it will come to you in one way or the other. So I'm going to pick on Elizabeth for a minute. Elizabeth, can I pick on you? Can I call on you?
Sure.
Okay, so how's that in the audit practice? How does that characterize itself? What I'm talking about? You deal with it all the time if you in the audit world.
So I don't audit anymore though. But refresh my memory.
But you used to, come on. No?
Yeah, the hours got really long, so I switched to consulting.
Okay, fine. In the consulting world, it's even more poignant.
So, can you repeat your question?
What's that?
Can you repeat your question?
So what would be, what sort of cost allocation problem do you deal with in consulting?
Just between like the different like levels of staff, for example, just allocating time, and it's more of like a budget issue.
Mm-hmm. And does that affect your life?
I'm sorry?
Does that affect your life? You know, the budgeting element of it?
Does that affect you?
Allocating partners' time, allocating managers' time.
Yeah, so like on our project, for example, just like we have to watch the budget. And even because my clients are primarily government, so a lot of times like they'll fund budgets for specific like titles. So we might have to like submit a contract modification if we hit like too much of like the partner's time, for example. So it's a real thing where like we have to watch it. We have somebody do it like week by week, they'll run a report, but monthly, like we might have to submit some kind of contract modification for it. Because, you know, we have to project time by level.
Wes Snow raised his hand. So first time somebody raised his hand their hand in the class. So Wes, what do you have?
I have seen fixed one-time allocations in at least 1 year instance, and I know that could have I didn't witness the effects of it, but I could assume where you have something like that where the actual allocation kind of falls into the background and is only noticed by maybe the top people, and the people that might be driving the cost don't see the negatives in that fixed environment and may, you know, overuse the shared services. So there's an argument at least against having a fixed one, and certainly a fixed one that's maybe only applied once a month or once a year.
Mm-hmm. Absolutely. There's no right answer.
But
Go ahead.
I will say that like even like with fixed cost contracts that I have in my company, like we still get charged, like we still have to be profitable for the project, like internally. So even though we're profitable, like the company makes money on the project, like, you know, everybody has like an internal bill rate. So we want to make sure that we're as profitable as possible. So even with those like fixed contracts, we have to closely watch hours.
But do you get charged in those in those individual profitability measures for overhead or not?
Yeah. So every like the budget, I guess everyone's internal cost has overhead built in.
Okay, so you know, so each one of you will one way or the other be impacted by it if you're ever going to manage any sort of product. Anybody here in government contracting? Federal government contracting?
I am.
Yeah, I am as well. I used to be.
Any insights from your jobs on this?
You go first.
You go ahead.
As far as the budget goes, I think everyone's pretty familiar with federal government. You spend it, you lose it the next year. Kind of goes against on our side. You know, we're not looking at profit, right? In the federal government, we're in an interesting position because I'm also a taxpayer, right? So I would love every savings I can get in the government. I think the most difficult part of my job is I see a lot of waste. So I think it's a very unique position to be in government contracting.
So you're on the government side of the contracting.
Right. Sorry, I'm actually a contracting officer, so I procure on behalf of the Marine Corps, which makes my job tough.
You would have to talk on the side. That would be fascinating to hear.
But at the same time, we have POAMs. You know, we build budgets 5 years in advance, and we stick to it. And then there's a new law or regulation. So for example, the federal government has always paid everyone higher living wages, higher minimum wages than states. Correct? I mean, until the past 2 or 3 years. And the position is always that the federal government trumps the state. Well, now a lot of states are going to $10, $15 an hour for minimum wage, and they're battling the federal government. These weren't in my POAMs. If a state makes a new regulation that says, starting in June, we're going to $15 an hour, now for certain military bases where we have joint agreements with the state, I have to scramble for money. So it's just to kind of add to your position about allocation. You can budget as much as possible, but depending on where you work and the line of that you do, there are going to be some cost drivers that you can't plan for, unfortunately, and they've heavily impacted the federal government for labor contracts, particularly I work. Just an example.
That's great. You're kind of not the consumer of overhead. You are billed for this overhead, right? So if you work with a contractor that allocates the overhead to the contract, and then they can bill you for that money, this is what we're talking about, an externality.
Oh, I'm an auditor.
Yeah, you're an external. It has an externality on you. Somebody allocates our overhead, some contractor and then bills the federal government. There's a negative externality. It increases federal government's costs.
Right.
Okay.
But I would never do that. I like firm fixed price contracts.
Absolutely. Cesar, you wanted to say something?
Yeah, so I mean, so I used to be a Fed. So I was with Homeland Security for a while. So I was not a CO, but a core. And then I flipped over and went to Microsoft. So I get a little bit of both. So from a contracting side, I agree. In the government, we're just trying to get butts on seats and get things done, but we're not necessarily in a hurry to get anything done. And on the contractor side, I can't speak for all the system integrators, but I can speak for Microsoft. We just want to do something, right? So we're passionate about getting a solution and deployed and done. And our frustrations and challenges are just to what she was saying before, is that things change and things don't seem to end. And even though for some integrators that just want to get staff augmentation people billing, makes sense. For us, where we're an organization that we just don't have enough people to do all the high level stuff, taking our resources and leaving them somewhere diminishes our ability to be able to do cooler stuff somewhere else. So we're not using our resources the way that we want to use our resource, and that becomes a problem. That's kind of my 2 cents.
No, I think it's a good point, because you just illustrated that I think what you were trying to tell us is that if the allocation is unfair, in a sense, it's too economically disjointed from the true consumption of resources. The extreme case might be that, like, suppose you have an organization in which no matter how much benefit they get from a particular overhead cost, everybody just gets 10% allocation, whether you get 1% of the economic benefit or 80%. Then it creates, well, for one, it's really bad morale. On the other hand, also really kind of distance. We talked about the properly aligned incentives, and some parts of the organization will be perpetually penalized for this cost. It's kind of very unfair taxation system, fundamentally. It's funny that on the chat somebody said, "I forgot who taxation is theft," and you guys were laughing about it. Does it mean we should never tax anybody? Well, you know, we would have a complete free rider problem. You know, that we would all be, we all consume government services, right? You know, right? How would we build roads? How would we have national defense? Because we're all consumers of that. The problem is that we're unequal consumers. That's the issue, right? We're very much unequal consumers. So taxation, I think unfair taxation or incredibly unfair taxation is a problem. That's why at the end of the day, progressive taxation is more prevalent, because it tries to capture that notion of fair consumption of resources to some degree. Or fair, you know, somebody who is richer presumably benefits more from the government, government largesse or whatever. Anyway, just as in taxation, there is no clearly correct answer. There is no clearly correct answer in cost allocation. You need to just be aware of the trade-offs. And I think everyone we talked about illustrated it even more. All right, that's kind of touches on questions 2 and 3. We talked about already the notion of externality. Externality is the unintended consequences of taxation. We just talked about that, right? We talked about with the case of the federal government is affected by how someone else allocates the overhead. They end up overpaying. And if they're overbilled, then taxpayers suffer because the federal government gets overbilled. There's, you know, there's waste. And these are examples of negative externalities. Explain the difference between non-insulating and insulation allocations. We talked about that already. Insulation allocations are allocations that are not dependent on the other party's performance. So if allocations are based on just everybody gets 10%, that's insulating. It's not driven by performance. In non-insulating allocations are based on either revenues or profits and things like that. So what's good about non-insulating allocations, which what Zimmerman emphasizes, is that in the good times, it creates less volatility. It makes it a little less risky. So because under the non-insulating allocations, better performing activity gets allocated more overhead. They get taxed more. It's like progressive tax. Whereas the more poorly performing activity gets taxed less, so they're not doing as bad. Absorption costing system is just some sort of a scheme for allocating overhead. It's a rule for allocating overhead. Full absorption costing requires that that's an accounting rule under GAAP for inventory. That basically says all costs associated with production of inventory, whether overhead or not, be absorbed in inventory costs. How could it affect firms' accounting production behavior? Well, the classic example is that because fixed overhead, which is an expense on the company, has to be allocated to inventory, and that's an asset, right? Essentially, by allocating this cost to inventory, we defer the expense until inventory is sold. So in any particular period, that if I want to defer essentially taking a hit on this fixed cost in my income statement, I can just produce more, and it will get, instead of taking a hit in the inventory, in the cost of goods sold, it just will sit in my asset in the inventory. And some of my early work that was published, some of the first papers that I published, maybe I think it was the second or third paper that I published in my career, we looked at that and we found that companies that have high fixed costs tend to do that. They are more likely to overproduce when they will, for example, have incentives to meet earnings benchmarks to show higher performance. What happens is that, of course, next period, you can't just sit in that inventory. You got to sell it. Once you sell it, you may have to, in order to be able to get rid of it, because it's costly to maintain inventory, you have to probably take discounts on it and so on. So your performance suffers. So it's just a way to shift, to defer costs from one period to another period. But the classic example in old managerial accounting textbooks talks about how high fixed cost firms have incentives to overproduce inventory because of full absorption costing. Explain differences between job order cost and process costing. So, and that's more from the previous semester of the course it took 5104. But job order costing is essentially costing based on the project, right? So project, when you have an individual job, and you can directly trace cost to a particular job or allocate cost to a particular job. So you can think of a my course as a project, right? So if you wanted to say, okay, is spring 2020 accounting 5154 profitable? Well, how would you evaluate that? Well, you have my salary, which is fixed number. So that's the direct labor. You have, until we got disassembled, disbanded or whatever you want to call it. Well, even now you have the cost of that room that we were in. That was the cost. And then you have the overhead costs correlated, that you need to allocate associated with the course. And that would be anything in that building, in the whole university, in that program that is needed to run this course, right? That would be you need to allocate the cost of, partly allocate the cost of the administrative staff, the dean, the security guard that sits up front, the IT, and so the library, whatever. But on the job order costing, it's allocated by the job, by the project, right? So if you work in the project management, and if you work in audit, consulting, whatever, that's all job order costing. So process costing is much more manufacturing when you have standardized product or processes. So where it's not like one big job, but like this iPhone, right? So you just have some sort of standard cost that you estimate and you apply to every iPhone on the basis of the processes that had to go in construction of that iPhone. So process costing is much more applicable to kind of a mass production environment. How is the overhead allocated to individual job? On the basis of the budgeted overhead. What is budgeted overhead? You take estimate in the beginning of a year, you estimate how much overhead you will incur totally, divided it by budgeted driver, which might be budgeted labor hours, budgeted square feet, whatever that is. And that's a rate that you will apply. And then you just take this budgeted rate and you multiply it by the actual observed labor hours that you incurred or something like that. And that's the allocation of the overhead for a particular job. Now the problem is that budgeted will over time, there's the actual expenditures of the overhead versus the amount of overhead you've applied. And so in the end of the year, there's always going to be a difference. If you spent $10 million, but you only allocated $8 million of overhead to particular jobs, there's $2 million of what's called underapplied or underallocated overhead. That needs to be somehow dealt with in the end of the year. Well, you can simply expense it, or you can reallocate it, whatever, but that's what's called a variance, overhead variance that you get from between budgeted and actual. The question also that Zimmerman talks about that's kind of relevant is, how do you decide what is this budgeted amount of labor hours or production runs, whatever, on which you're going to estimate your budgeted rate? What should it be? What should the volume be, right? Somehow overhead is driven by the volume. And so, he makes a point to say that you shouldn't be using just the current volume. You should be using some sort of a normal volume over time, some sort of a moving average or average volume over period of years or something like that, or months. And that's because you want to insulate this allocation or this estimate from like sudden production shocks or sudden volume shocks. You want to get some sort of take some sort of a stable average. And those are kind of the big ideas in these two chapters. Any questions, thoughts, concerns?
So, Professor, in this last chapter, I see kind of there are some problems also regarding the over-absorption and the under-absorption thing. So, little confusing to me. Do we need to prepare?
You don't need to worry about it. I mean, I want you to understand what that means, which is what I talked about, is that if you have the total, let me give you an example of the dean's salary. Let's suppose the dean makes $400,000 a year. That's the actual salary. But you want to allocate, you budgeted and suppose you budgeted last year that you'd make $350,000 and you allocated it between 3 jobs. Right? Because remember, you allocate overhead, you apply overhead using the budgeted amount. The actual amount will be different during that time, right? Because you can't control how much you spend money so easily. So this $50,000 you've under-applied to different jobs. What are you going to do with it? Right? What are you going to do with it? So you need to either reallocate it somehow between the 3 different classes of jobs or programs, right? Or you just need to outright expenses. Maybe if it's not a material difference, it would just say, forget it, I'm just going to take it as like an additional expense without allocating it to jobs. So same thing with the you can think of the inventory or whatever. So that's why, if you understand, that's all I care about.
Yeah, so I understand the variance part, like there could be plus variance or there could be negative variance, but the mechanisms, I mean, I saw some problems which has this, like, how do you remedy it? And, you know, you're saying it theoretically, like allocate it or expense it. So that part is, I don't know how much you need to.
You don't need to worry about it. It's way too technical, and
it seems because without it seems like you need to have a very deeper understanding of how expenses and how this thing work. I mean, I understand the variance, that's clear. But
okay, so for your purposes, I think that's enough. And by the way, Zimmerman goes, in my opinion, way into much detail and see the
and the book